What is the state of global economic growth today, and how will base metals, steel, aluminum, and raw commodities be affected by our current situation? Joining me to talk about this is Neal Brewster, Manager of Strategic Consulting at Roskill. Neal, welcome to the show.
Thanks, David. Thanks for having me.
Let's start with your macroeconomic outlook, Neal. Where do you see global growth lying in the rest of the year for 2020 and beyond? And, we're coming out of a pandemic. Some people think that we're going into a V-shaped recovery. Others might disagree. What's your take?
Yeah, so David, it's a very period of high uncertainty at the moment. I guess what we are now seeing is sort of new data coming out that is seeing the upturn taking place. So I guess key uncertainty is the strength of that recovery. Our view is still, I think, relatively optimistic, and that's quite a low bar compared to a lot of forecasters. But in China, we're seeing growth industrial production up, 4% year on year. In the US last month, IP rose month on month for the first time. So we are seeing the bottom of the recession. In China, obviously, China consumes over half of global metals now. We think growth by end of the year will be back up to about 6% year on year. So across 2020 as a whole, that still implies quite weak growth, probably around 2% year on year. But by the end of the year, we are seeing that recovery taking place. That, of course, is not without its risks in terms of COVID and a second wave of the virus that might dampen some of that outlook.
Let's look at the metals that are impacted by the auto industry in particular. So I've heard two conflicting arguments about the auto industry. One, which is that as people come out of a recession, they're going to be postponing their big ticket purchases like auto vehicles for quite some time. The counter argument is that as we have more social distancing rules in place, people are going to want to purchase vehicles to stay away from public transit. Do you see car sales pick up, or do you see it flatlining? What's your view?
Yeah, our focus very much at Roskill is on electric vehicles because they drive some of our key markets. So it's lithium and cobalt. Electric vehicle sales are actually doing pretty well, and I think those will come back much more quickly. And I guess we might see governments actually encourage the EV sector. So for those particular markets, we're actually quite sort of bullish and good underlying drivers longer term drive those markets forwards.
And on lithium, we're seeing the technology behind electric vehicles progress really rapidly. Tesla, for example, is constantly revamping the way their batteries are being produced and increasing their battery capacity. How do you see the growth, just on a longer term basis, of the technological improvement of EVs affecting lithium demand over the next 5 to 10 years?
Yeah, so we see markets being affected, being lithium, being cobalt, and sort of nickel. In terms of battery technology, we're seeing a shift towards higher nickel intensity batteries. So our view on nickel is particularly kind of bullish. Cobalt will also have some offsets against that, but cobalt sort of is much more focused on the EV market, so it's much more exposed to changes in EV sales. So cobalt will kind of lose share of market, but it's a fast growing market, so still positive growth year on year. In terms of lithium, lithium demand could be growing, double digits, so 15% year on year over a number of years. I guess lithium's had a bit of a correction in the last couple of years. So if you go back to sort of 2017, there's a lot of enthusiasm for the sector. We probably saw supply overtaking demand, and that caused quite a fall off in prices. That's now kind of bottomed out. And actually, in terms of investment, that drop of investment in the last couple of years kind of means that as demand picks up, lithium prices should perform relatively strongly over the medium term.
And on the supply side, in terms of mining, what are we seeing miners do, and how are they reacting to the current situation and projected demand, like you just said?
Yeah, so I guess there's quite a few things around that, and something that's very commodity specific. So in some of the kind of bulk ferroalloys markets, we saw cuts to kind of port and rail capacity in Africa, and that constrained supply of things like chrome and manganese ore and tantalum as well from Africa. In those markets, actually prices have gone up year to date. So despite the macro outlook being quite negative generally, where we have seen supply disruptions, prices have actually performed pretty well. And that's sort of, that's very specific to those markets. But more broadly, commodity prices have performed remarkably strongly. So in a typical kind of recession, we see price falls of sort of, 50% taking place. In terms of our index of metals prices, it's actually down about 6% in terms of Roskill's coverage, which is remarkably strong given the kind of macro context. And that in part reflects those supply adjustments. And that part of those are sort of COVID effects in terms of infrastructure. It's clearly part of that story.
Finally, Neal, a lot of investors over the last few months were surprised at how disconnected the equities markets were in comparison to the real economy. Just based on your research and your area of focus, was there anything in relation to auto sales, electric vehicles, industrial metals that really stood out to you in the last few months that you looked at and thought, this really didn't make any sense at all?
In terms of valuations in the mining sector, I think what's interesting actually going to the downturn is there's quite a lot of pessimism about mining, last year. So actually, given how well that mining sector's held up in terms of prices, given that already kind of built-in pessimism, mining's been pretty strong in terms of equity performance. Clearly in gold's got its own unique characteristics because of the gold price and kind of risk on, risk off kind of trading. But more broadly, the sort of the FTSE mining index, the ASX mining index, is pretty back to where it was start of the year, and that again reflects that resilience in mining prices, and the fact that probably there's a lot of downside already priced into the market going into the cycle. So it's fairly kind of broad brush, in terms of what it means. Gold's performed well, iron ore's performs really quite well as well, and that's kind of, I guess, that China-centric focus in terms of China picking up much more strongly. So it's pretty much across the board in terms of that resilience. But I guess some of those kind of bulks, those bulks have held up particularly well. Coal not so much, clearly, driven by links to the kind of oil price.
And for the investors who are long the industrial sector, what are the key risks that they need to be watching for the next 6 months to 12 months?
Yeah, I think, our in-house view in terms of the next 2 quarters for metals markets, I mean, whilst I say we are sort of, relatively sanguine about the economic outlook and think, world economy will recover pretty strongly, it still is kind of a pretty poor kind of outlook. And I guess because the economy stopped so quickly, we didn't have that kind of normal, destocking phase. And what that means is we might not see that kind of restocking phase on the other side on in terms of the kind of way out. So we might not see that restocking phase taking place. And because those COVID effects mean that supply, can come back on as well, we might see supply kind of come back into the market. So our kind of, 2-quarter outlook is sort of relatively sanguine about the sector, given where we are today. So, not doom and gloom, but I think cautious about next 2 quarters, just to say that there's some resilience there, but don't get too carried away.
Okay. Thank you very much for your thoughts, Neal. I appreciate you coming on the show today.
Thank you.
I'm David Lin. Stay tuned for more coverage of the Minds of Money Online Connect at Kitco.com. Thank you for watching.